Good evening. Today is a Monday, the 7th of October 2013. I am G. Ramachandran, Gopalan Ramachandran, also known as Ramach to my friends. I wish to present an assessment of the low interest rate loans that the government plans to make available to India's retail consumers in league with India's gigantic banking industry. The suggestion that involves low interest rate loans has been dubbed by the media as cheap loans, cheap in the sense that they're not very big in magnitude. At the same time, the interest rates that these loans would carry wouldn't be very big, so cheap loans. And first pass, the assessment of the cheap loans has been adverse. One deputy governor of the Reserve Bank of India and a bunch of analysts feel that cheap loans would erode the quality of the assets that the banks hold in their books. And I wish to have a contrarian view, and I would like to say why cheap loans to India's consumers would make a very big difference to the Indian economy at this point in time. Okay, whenever we talk about timing of policy, we look at economic cycles. And economic cycles actually include many other cycles. And I wish to basically pick three of those sub-cycles, if you can take them to be that. The business cycle, the liquidity cycle, and the fiscal cycle. In the sense that the fiscal cycle is one that the government gets into. It involves the government's books and how easily they would be able to balance their books with the tax inflows, and so also to facilitate the investments in social infrastructure. The other part is the liquidity cycle, the kind of stuff that we normally talk about in the banking industry, which involves societal savings and the magnitude of investments that these savings will go on to fund. And the third part, of course, is the business cycle, that businesses themselves go through cycles of rapid growth, then a stable consumption, and then some kind of a further investment, and they keep moving from one bottom to another top, and then they keep hitting some kind of, let's say, growth snafus, and they move further up. Okay, the feeling now is the Indian economy has stuck into low gear, or has stuck itself into low gear, and the growth numbers spoken about by the analysts as well as the Planning Commission don't look too big. And in these circumstances, if growth itself is not too big, the growth in tax revenues too would not be that big, which also hampers the ability of government to go ahead and make those very important investments in social infrastructure aimed at making people's lives that much better. At the same time, the banking industry holds a whole lot of lumpy assets that aren't doing too well. But these borrowers are very big and they operate in many different sectors of the Indian economy. Some of them are in infrastructure, some of them are in passenger aviation, some of them are in the real estate, the realty sector. What should the government do then to break the log jam and ensure that the three cycles, the business cycle, the liquidity cycle, and the fiscal cycle, do not impair the ability of the government to go ahead and promote growth? At the same time, the government's actions, along with the principal lenders in the Indian economy, should be able to lift many sectors, many borrowers out of trouble. And in this regard, the suggestion of making available low interest rate loans to India's retail borrowers, the households, the ordinary retail consumers makes great sense. Let me start with this. Credit can be classified into retail credit, which is consumer credit, and corporate credit, which is business credit. The two classes of credit can be further once more into revolving credit and non-revolving credit. Revolving credit is what companies typically see as working capital. You need that all the time. At the same time, at the retail level, revolving credit could be seen as the usage of credit of the credit card. People use credit cards, they spend, and then they repay, they keep moving. By contrast, non-revolving credit is usually applied towards the acquisition of capital assets. At the level of a household, capital assets include appliances and motor vehicles. For companies, of course, non-revolving credit would be investments in plant and machinery. I forgot to add that non-revolving credit at the level of the consumer could also include home loans, which of course is what the realty sector ultimately banks on when it sells dwelling units to its customers. Now, let me tell you why low interest rate loans would do a good job at this point in time. First, consumer credit is very granular. No borrower is going to borrow a very large sum of money. The incremental credit risk at the level of each borrower is fairly small. At the same time, there are millions of households in India waiting to buy some of the appliances that make life better and motor vehicles. As a consequence, you get to diversify risk, and the collective amount that these retail consumers would be borrowing may not be very large. Let me not get into numbers, but what happens is, because you have low interest rate loans for the acquisition of these assets, households make that very important decision to buy the asset. These assets, the motor vehicles and appliances, are made by companies. Their cash flows improve. As a consequence, the borrowers from the banking industry, with working capital, plus of course non-revolving capital expenditure that's been funded by banking credit, get to see more cash flows. These loans get better at the level of the banking industry, in the sense that there's a decrease in risk that the collective corporate book would present itself to the bankers. Plus, of course, we have the added advantage that when you look across sectors, multiple sectors could have some very healthy borrowers and some that are stuck in low gear or low production. So, from a perspective of page-by-page analysis, each sector gets to have a slightly better or healthier future, with some of the companies that went until now paying back large sums of money, getting into a position to pay out those cash flows, those interest rates, and part of the principal that they need to pay the banking industry. And these acquisitions involve excise duties, and these are tax inflows to the government. So the fiscal buoyancy that the finance minister talks about is going to be accomplished by these tiny acquisitions over millions of consumers. They themselves will produce a lift in the tax inflows to the government. At the same time, the banks aren't going to be parting with huge chunks of money. First, consumer loans by themselves are small, as I said a while ago, and these are loans that the government and the government-owned banks could be encouraging in order to lift the overall risk profile. The addition of retail credit or retail consumers in the asset book of banks reduces risk because they are diversified, and households think twice, thrice before they default on a loan. That's very clear. Individuals are a lot more caring about their credit profile and their relationship with banks. Big borrowers present a huge risk, a lumpy risk, and their hesitation to pay back principal or pay whenever interest is due shakes the foundations of the banking industry. By contrast, tiny, healthy retail borrowers change the overall approach to risk management. Now let's consider this. If the finance minister and the central bank had come up with a suggestion of making low-cost, low-interest rate loans to India's corporate sector, the press would have been very happy. The media would have been very happy. Analysts would have said it's the right move so that India can go ahead and fund infrastructure and make available funds for capital expenditure. But we are in a situation in the business cycle where a whole lot of assets aren't producing what they're supposed to be producing. These assets are there in the power sector, they are there in the aviation sector, they are in infrastructure, they are in the realty sector. So there's no sense really of further reducing interest rates or making available more loans to this sector. So we need to break the log jam. And in this regard, cheap loans would make the banking asset portfolio healthier, and very importantly, they reduce the risk of a huge number of corporate borrowers who would find that their output now finds a market. And that's very important because without revenues, borrowers wouldn't be in a position to pay interest and to repay principal. There's another thing really, the aspirational part of it. When someone buys a new asset, the old asset has to be sold. So India would be kickstarting a very healthy and viable market for used goods. You will find a huge service sector spring up to put back used cars, used appliances back into shape and expand ownership. Ownership of assets improves lifestyles. Ownership of assets improves income-producing activities within a home. These do create comfort, these do create a whole lot of conveniences, but the fact is the availability of such goods down the line enables people to aspire, meaning going out and getting a job, going out and consuming a little more, paying those excise duties. So that will be basically a two-pronged flow-through effect that the banking industry would see and the economy would see. There's a third part to the whole thing. What happens when normal consumers start buying goods? The banking industry's principal feeling is that there would be an aggravation of risk and that such low-level borrowers would impose on the banking system a huge cost of administering these loans, credit appraisal, and that's probably one of the reasons why the banking industry in India is very comfortable by making large loans to a few borrowers, thereby reducing their costs related to credit appraisal and credit administration. So what should the banking industry do? Should they really open the doors to a whole lot of borrowers from the retail sector? Probably not. They need to do the cherry picking. Let's consider this. Every bank can choose to first lend to the most creditworthy borrower at the top of the pyramid and move down. When you lend to the most creditworthy borrower, the overall credit risk within the banking system reduces. But then what happens is that household is going to sell a used good. So there's another market kicking down there. And soon when people make important comparisons between the utility of used goods and new goods and their prices thereof, some households will make a major trade-off. They will pick to buy or choose to buy a new good. And therefore the market moves one tier down. In the meanwhile, the banking industry has been comfortable making the first loan to the best borrowers, stay with them for a quarter, find out how things are proceeding, and keep lending. It's not an epochal incident that the banking industry would be handling. The suggestion of the finance ministry and the central bank does not mean that the entire lendable resource would be lent in a day. Not at all. The process has to begin sometime now, and as the banks cherry pick their way down from the best quality to one level further, new jobs are going to be created because consumption by itself produces a very important secondary effect. So new employment opportunities get triggered, and these are the guys who are going to come back. These are the households that are going to come back to borrow from the banks with a healthier income statement. Their own payroll looks better, salary certificates look better, their ability to make a down payment looks better, and I think that's exactly the way India should do things at this point in time. We are in October 2013, and it's going to be a while before we look into the seriousness of managing our fiscal situation. A plan such as this, which is of course being dubbed by the media and analysts as the cheap loans idea, would have taken root some months now, and a quarter from now we would know how we're going, and banks would be in a position to understand how to administer credit over a large number of household borrowers and put in place the collection mechanism and learn a whole lot. So I think we should welcome this idea. Cheap loans are very good for the Indian economy at this point in time. The business cycle, the liquidity cycle, and the fiscal cycle demand such a happy move which ensures that our economy will not be stuck in low gear for too long a time. When I have new ideas on this subject, I get back to you, but for now, think about it. Thank you very much. I'm Ramach. Thank you.